The stock market just soared in a major way, with the Dow Jones jumping an impressive 500 points to set a new record high. But here's where it gets controversial. Despite a recent uptick in consumer inflation, many investors believe this won't stop the Federal Reserve from cutting interest rates next week, a move that could have far-reaching impacts on the economy. On Thursday, investors across the board got optimistic as stocks rallied, driven by expectations that August's inflation figures won't force the Fed to delay its planned rate cut. The Dow surged by 504 points, or about 1.1%, while the S&P 500 climbed 0.6% and the Nasdaq Composite rose 0.4%. Remarkably, all three indexes hit new intraday all-time highs, demonstrating broad market enthusiasm. But the inflation data itself was somewhat puzzling. The Consumer Price Index, CPI, for August showed a monthly increase of 0.4%, slightly higher than the 0.3% economists had forecasted. Yet, when looking at the year-over-year numbers, the inflation rate came in exactly as expected at 2.9%. For those unfamiliar, the CPI is a key measurement that reflects changes in prices paid by consumers for goods and services, and these monthly and annual fluctuations play a critical role in shaping monetary policy. Digging deeper, the so-called core CPI, which excludes the more unpredictable food and energy prices, increased by 0.3% in August and 3.1% over the past year, aligning perfectly with predictions. This softer measure is considered a better indicator of ongoing inflation trends, removing the noise of volatile sectors. Adding to the complexity, just a day before this report, the Producer Price Index, PPI, which tracks inflation at the wholesale level, unexpectedly fell by 0.1% in August, suggesting some easing of inflationary pressures ahead. At the same time, labor market data further hinted at cooling. Weekly jobless claims unexpectedly jumped by 27,000 to a seasonally adjusted 263,000, the highest level since October 2021, signaling that layoffs could be rising. This spike came shortly after previous revisions showed weaker job growth than initially thought. For context, weekly jobless claims measure how many workers newly file for unemployment benefits, often seen as an immediate indicator of labor market health. Following these economic releases, Treasury yields dropped, with the 10-year Treasury note falling to around 4%. This decline in yields typically reflects investor demand for safer assets amid uncertainty or expectations of easier monetary policy. Investors widely believe these signs of slowing economic growth are setting the stage for the Fed to cut interest rates by 0.25 percentage points when it meets on September 17th. In fact, betting markets show an increasing chance the Fed might even go further, cutting rates by 0.5 percentage points. Jay Woods, chief market strategist at Freedom Capital Markets, put it succinctly: a quarter-point cut is basically a sure thing, but the numbers keep a half-point cut on the table, especially when you consider the recent jobless claims data. The key thing to watch is the 10-year Treasury yield. If it dips below 3%, we could see the market rally even more. This market optimism comes on the heels of remarkable performances from technology stocks like Oracle, which recently soared after announcing strong growth projections for its cloud business. Oracle's shares surged to their best day since 1992, gaining $244 billion in market value and injecting fresh life into the wider artificial intelligence investment theme. Chris Zaccarelli, chief investment officer at Northlight Asset Management, put it bluntly: the door for rate cuts is wide open now. The narrative has shifted rapidly since last week's jobs report. It's no longer about if the Fed will cut rates in September, but how many cuts we'll see afterward. This dramatic change in sentiment underscores just how sensitive markets are to the latest economic signals. While the Nasdaq and Dow both reached new all-time highs on Thursday, with the Nasdaq climbing to 22,002 and the Dow hitting 45,992. The S&P 500 also marked a fresh peak of 6,572, fueled by enthusiasm across sectors. Before the opening bell, some individual stocks made headlines. Open Door Technologies jumped 33.6% after naming Shopify executive Kaz Nejatian as its new CEO, a move that excited investors following the last CEO's recent resignation. Oxford Industries, maker of Tommy Bahama and Lilly Pulitzer, also jumped 18.3% after beating earnings expectations and reporting that tariffs would have less impact than previously thought. Meanwhile, fintech giant Klarna dipped slightly after its recent IPO rally, illustrating the market's complex reactions to different stories. Inflation figures overall showed that consumer prices rose 2.9% year-over-year in August, exactly on target. However, the unexpected monthly rise of 0.4% above forecasts hints that inflation remains a delicate balancing act for policymakers. Adding to the week's big financial stories, crypto lender Figure priced its IPO higher than expected at $25 per share, valuing the company at roughly $5 billion and preparing for its debut trading day on Nasdaq. Meanwhile, Citi raised its price target for semiconductor giant Micron Technology from $150 to $175, forecasting strong earnings driven by rising sales of memory chips primarily for data centers. Yet despite all these positive signs, some market watchers remain cautious. David Rubenstein, co-founder of the Carlyle Group, warned that a half-point Fed rate cut next week might spook markets, as it could signal that economic conditions are worse than investors realize. Rubenstein believes only a more modest 0.25% cut is appropriate and less likely to unsettle the markets. In terms of labor trends, Wells Fargo's Scott Wren highlighted that although the job market is slowing, companies aren't yet firing employees en masse. Jobless claims remain below 300,000, a threshold often crossed even during strong economic periods, indicating businesses are holding on to workers for now, just not aggressively hiring. After hours, some market movers included Oxford Industries rallying further thanks to strong earnings, while Alibaba's U.S.-listed shares dropped 2% on news of a new convertible note offering. Stock futures for the Dow, S&P 500, and Nasdaq 100 remained steady late Wednesday, pointing to a cautious but optimistic mood ahead. So here's the million-dollar question. With inflation sticking close to expectations, yet jobless claims rising and Treasury yields falling, is the Fed's rate cut a signal of confidence in economic stability or a warning that trouble lies ahead? Are investors right to feel buoyant, or is this optimism a dangerous risk? We'd love to hear your thoughts. Do you agree that a rate cut is imminent and beneficial, or do you foresee pitfalls the market is overlooking? Join the conversation and share your take below.